Hello, class. Welcome to week one of Principles of Accounting 1. So I wanted to go over some introductory items to help you do your homework and grasp concepts in this class. So accounting is a subject that's going to build upon itself. So every single week, we're going to have new items that we're going over, but it's going to build on the information that we learned previously. Therefore, as you're working through your homework and the material and understanding the concepts, be sure that you have a firm grasp of everything, because if you don't understand everything in week one, when you go into week 2 or week 3, you're going to be even more confused. And so it's really, really important that you get the foundation, under control at the beginning of the course. So that's what I'm hoping to do in this first week, is lay a good foundation for you guys. If you guys have any questions, be sure to reach out. So, all right. So accounting operates completely around one mathematical equation. Okay. The good news is it's a simple equation. So it's assets equals liabilities plus equity. Okay. Assets equals liabilities plus equity. All right. So assets are what you have, and liabilities are what you owe, and equity is what you owe. Now, you and I both know that just because you have something doesn't mean that you own it. Okay, so for example, if you have a car that you're making payments on, you only owe the amount of that car. You only own the amount of that car that you've actually paid on. Okay, whatever you owe on, the bank technically owns that portion of the car, the financing company. Okay, same thing with a house. You only own the portion of the house that's paid off. Okay, if you have a mortgage on your home, and the rest of the home is owned by the bank. Okay, so this accounting equation measures of what you have and how much of what you have do you owe on, and how much of it do you actually own. All right, so for example, let's say you have assets. Let's say you have a $100,000 house. You buy a $100,000 house and you put a 20% down payment on it. So $20,000. That means that you're going to have $80,000 in liabilities. Okay. Now, if you pay attention to this equal sign right here, this right here is very important, because on this side of the equation, we have $100,000, and then over on this side of the equation, we have $100,000 over here by adding the 20,000 to 80,000 together. So the accounting equation must always balance. Okay, let me say that again. The accounting equation must always balance. If the accounting equation does not balance, then there's something off. Something is wrong. So it's a good check for when you guys do your homework. If the accounting equation is not balanced, then you've done something wrong and you go back and find the error. Okay, so now assets are what you have. So let's say we have, for example, a landscaping business. Okay, what are some things that a landscaping business could have, but they don't necessarily own? Okay, well, the first one would be cash. Okay, so cash is something that you can have and not necessarily own. So if I go borrow $10,000 from a bank, then I don't own that cash. I just have it. Okay, so I can either own the cash or I can borrow the cash, one of the two. Okay, accounts receivable. This is when someone owes you money. Okay, so let's say that we mow someone's yard and they have not paid us yet. Then what they have with us is called a receivable. This is a record of who owes us money. Okay, so a lot of times in business, this is referred to as receivables. The correct, total term is account receivable. Okay, see, supplies. That is also an asset. So supplies would be like, for example, like this pen, a legal pad, markers, paper clips, paper clamps. Those are supplies. Okay, so you can borrow money or buy supplies on credit, or you can buy them outright. Inventory. So inventory could be something that you have that you just don't necessarily own, because you can buy that on credit. And then also we'll say like equipment and land. All those things are stuff that you guys can buy, and you don't necessarily own it. Now, under accounts payable, or I'm sorry, under liabilities, we're going to have an account called accounts payable. So accounts payable, this is the record of who we owe money to. Okay, so for example, let's say we owe money to South Bank. Okay, then accounts payable South Bank. And then let's say we owe money to Lowe's Hardware. So we're gonna have an accounts payable for Lowe's Hardware. Say we accounts payable to Staples. We buy supplies there on credit. Okay, so that these all represent money that we owe. And then under common or under equity, we're gonna have what we call common stock. So common stock, this represents ownership in the company. So if you own stock in a company, for example, my grandfather owned stock in Walmart. He is an owner of Walmart, a very small percentage owner. He barely owns any percentage of the company, but he is an owner nonetheless. So common stock, so this is to track the ownership. We're also going to have what we call retained earnings. Retained earnings is like the savings account of the business. Dividends, this is whenever the pieces of the profit get paid out to the common stockholders or the stockholders, because profits get paid back to the owners. And then also we'll have revenue, which is when you bring in money into the business, and expenses. This is when you pay money out of the business. Okay, so that is how the accounting equation works.